Hey, welcome to today's video, part 2 of inventory. So previously we looked at FIFO, identified cost, recording, how that looks in the journals. Today we go a bit more in depth, and this time we're looking at more valuations. So we're going to see the impact of different valuations and when to use either product costing or period costing. So that's going to be sort of our main focus and hold everything together. And then we're just going to expand out from there. So looking ahead, let's go into what is product cost. So product costs, they are costs that can be equitably distributed towards the cost of a product. So product costs can be allocated to individual units of inventory on a logical basis. So a very quick example here, if I get 15 items and delivery costs $15, you can equitably distribute that, and it makes sense, and all that inventory is the same. So it's just equitable, logical distribution. On the other hand, period costs are costs that cannot be distributed equitably to products. This normally happens with flat fees and independent of the amount purchased. So if we had a flat $100 shipping fee, regardless of what we purchased, that would be a little bit different. So what we're going to do is going to look at applying the product cost, the period cost, and we're going to look at a variety of scenarios. So we're going to go and show what that looks like. We're going to show that along the period, the product cost, then the period cost, with some overarching examples. We're going to move on to then net realizable value, and after that we're going to see how this appears on the income statement. Then lastly, we're going to do some theory work. So we're going to have inventory turnover and reporting, and yeah, that's everything we're looking at. So just that inventory turnover has some theory questions as well. So on that note, let us begin. So we're going to start with our overarching example. On the 15th of April, McAvoy Golf Gear purchased 15 golf bags from Bear Industries, invoice 361. We purchased 15 at $100.90 each, but there was also $150 cartage in, or cartage in is delivery fee, from the supplier, Bear Industries. So we have to pay all of that. And because it's under the one transaction, invoice 361. So 15, 150 cartage in, 15 products. Obviously, that's going to be a product cost because it can be equitably split because there's just 15 golf bags. So you can equitably split that up. So ergo, $115 divide by 15 is $10 for each additional item. And it's valued as such. So 190 plus 10 makes 200. On the invoice card, or the inventory card, we see invoice 361 on the 15th. You see 15 in at 200, 3,000. And that's just added on to the bottom. So our general journal displays inventory 3,000, GST clearing 300, both debits because inventory is going up and we're paying GST, making that liability go down, and the accounts payable 3,300 because that's the total value of the invoice. Now, what if we change one thing up? So this time, the cartage in delivery fee, instead of being from the supplier Bear Industries, it's a third-party courier, Green Circle, that delivers them, and we pay them cash on the spot. That's check 52. Now, all our numbers that we previously did stay the same. It's still $10. It's still product because it can be equitably split. How does that appear on our inventory card? So you see the 15th here. This time we've put both in, or both source documents, invoice 361 and check 52, but the in still stays the same and the balance will still stay the same as as the previous one. So the main reason we do this is to record the check, and because it's the same date, we can combine them. So if we have a look at our general journal, this time it's changed a little bit. So we've done the 2 separate transactions because each transaction needs to be recorded if it's a separate source document. In this case, invoice 361 versus check 52. And we see inventory 2850, GST 285, and the accounts payable this time is 3135. And the accounts payable credit, inventory and GST both debits. There we go. Now, the second one, check 52, also on the 15th, we add that 150 delivery or that cartage in directly into inventory because it's a product cost. So that inventory debit 150, GST debit 15 because we're paying GST, that liability goes down, and our total cash only reduces by 165. And in the balance sheet and all that, you can see, and if we bring up the inventory card again, we can see that is the same. So, product cost, this time we're going to change it a little bit more. So, on top of a third-party courier, this time it was still Green Circle, it delivered them on the 17th. So, we got the invoice on the 15th, and on the 17th is when we received the products and it was delivered to us and we paid that delivery. This time we record it separately. So we see 15 at 190, and then on the 17th we go 15, and this time it's only 10 because the number's still the same. Only difference is the date. So if the dates are different, you need to record it separately. Now 15, when you look back, this will stand out if you're reviewing your numbers, but if you're able to look back at the source documents, and that is verifiability, you'll see where this lines up. And this time the only difference for our transaction is the date has changed. So it's the 17th, but everything else stays the same. So let's do a quick recap of this. If it's all in the one transaction and it's a product cost, you can combine it all. If it's different suppliers but on the same date, so different source documents, you just need to put both source documents in the details of the inventory card and 2 separate general journal transactions. And if it's a different supplier and a different delivery date to when you purchased, you would put the inventory invoice on one, and then you would, on the second date when we received them, add the delivery in, and because of verifiability, we're able to double check all that information. So that's where that would come in. And in the general journal for both different suppliers, you would need to, because again, separate source documents, you put them both in the general journal. So that's a very quick, brief walkthrough in product costing. But let's do period costing now. Period costing, just a reminder, is when costs cannot be distributed equitably to products. This normally happens with flat fees that are independent of the amount purchased. So we're back at McAvoy Golf Gear, and we've purchased 20 shirts at $23 each and 10 golf hats at $8 each from Nickwell Clothing, invoice 67. Okay? So we see here our shirts will total us $460, our hats will total $80, but we've also got a cartage in fee from the supplier of $50 and 5 GST there as well, just a heads up. So that totals $590, GST is $59, and the total invoice amount is $649. Now, we look at the delivery cartage in fee. It's $50 for 30 items, and there are more shirts than hats. You can't equitably split this. There's no logical mathematical way to do this because shirts are different to hats. That's obvious. So we need to figure out how do we deal with this. And this is where period costing comes in. So we've already said the total invoice is $649. So we're going to put that in the accounts payable on the credit side, because that's what we now owe. Our inventory we totaled was $460 plus $80 for the shirts and the hats. That's $540. The cartage in is going to this time be its own expense. So that's a debit of $50 because in a expense increasing is a debit. And then GST is going to be applied for both the inventory and the cartage in, because delivery or cartage in is a service. So 590, 10% of that is 59. So what can be considered period costs? The most common ones you're going to see in both Unit 3 and Unit 4 are going to be logos, add-ons, and paint jobs. And that extends to other one-off costs as well. So like any security systems you might do when we do non-current assets. But we'll get to that in Unit 4. That's a Unit 4 problem. The other one is delivery. That's the other one we're going to be dealing with. In this case, it is a period cost. So how does that appear on the income statement? And we're going to do an extract of McAvoy Golf. So you see here, we've got the cash credit, sales returns. We've got all that. I'm just going to leave that there. I want to focus on the less cost of goods sold. So you see what they've sold here, $16,070. But then you've got delivery, cartage in fees, which is $150. So that $150 would include the $50 we did there. So that delivery cartage in fee is a period cost. And that's where it belongs, in the less cost of goods sold area, and helps calculate our gross profit. Now, that differs to product costing, because those costs are expensed on the cost of sales. So product costing always expensed on the cost of sales. Period costing always its own thing in the period that it occurs. Now, if we extend a bit further, we're going to stay on McAvoy Golf, but this time we're going to look at a new concept, this time lower of cost and net realizable value. So we've got a new term, net realizable value. What is net realizable value? It is the estimated selling price of inventory less any cost involved in its direct selling, marketing, or distribution costs. So just be aware of any of those. So the formula will be NRV equals estimated selling price less direct selling expenses. And what are some examples? Some examples are, if you purchase this item, we'll give you a free box for it. Or we do targeted advertising for that item. It's just those little things. So NRV, again, estimated selling price, less direct selling expenses. Now, what happens is we can create situations where our net realizable value is less than the cost of the inventory initially. Why? Well, quite simply, sometimes we do it because we just want to get rid of the inventory, like a clearance sale or an end of season sale. So we need to get rid of it, because it's if we keep it on our shelves, we get nothing for it. And it's a case of essentially something is better than nothing. So let's do our worked example. As at the 1st of April 2025, McAvoy Golf had 6 pitch and putt putters, currently valued at $50 each, but have been a slow seller. On April 30, in an effort to sell said putters, McAvoy Golf have made a special to sell the putters. They have reduced the price to $40 each, and every golf club sold comes with a cover for the golf club that is worth $10. This is memo 10. So let's put our math here. So on one side, we've got the inventory value of $50. Keep that in mind. We've got the selling price of $40 and the selling expenses of $10. So the NRV will be the selling expenses minus any direct selling expenses. So 40 minus 10 is $30. So we see here $30 NRV is less than the inventory value of $50. So that's $20 per item less, or $120 overall. And what that creates is an inventory write-down. And how does that look? So we go April 30. Inventory write-down is an expense, and its expense going up is a debit of the total amount, so 120 debit. And we write down our inventory value. So our inventory being an asset going down is a credit of $120, and our narration will be write down of inventory memo 10. And how does that look in our inventory card? We see here April 1, you see 6 at 5,300. They didn't sell any. 30th, they got memo 10, and then 6, 20, 120. And then you can see here the balance becomes 6 at 30, 180. And this is the outcome because the value is going out. So that's where that comes in. And the reason you might think, oh, but like, what would happen? You look at the memo and you think, oh, what happened? Read the memo. Again, it's all linking back to verifiability. So how do I... Actually, we'll see how that shows on the income statement. So we've got the same income statement. We're just building on it a little bit more now. So we look at the revenue. Everything's the same. Less cost of goods sold. We still got that period cost there. But if we look at gross profit, we see less inventory loss, 260. Less inventory write-down. So inventory write-down goes under gross profit and is used to help calculate adjusted gross profit because that helps us with our inventory management. And we can see here that would impact the adjusted gross profit. So we just got to remember this rule. So here we go. If cost is less than the net realizable value, then the cost of the inventory will remain the same. But if our NRV or net realizable value is less than the cost of the inventory, then we need to do an inventory write down. So if NRV is less than costs, write down the value. All right, lastly, we need to do a bit of theory. And this time we're looking at the inventory turnover. So previously we've looked at the accounts receivable turnover, accounts payable turnover. This brings together the holy trinity of the cash flow cycle, and it's inventory turnover of average inventory over cost of goods sold times 365 days. And this gives us the average number of days it takes us to sell an inventory item from when we receive it. So, what are some problems with bad inventory turnover or inventory turnover that trends upwards? What can go wrong? Well, quite simply, it's firstly telling us our items are super slow to sell. That's bad. Now, if it's slower selling, it means we're taking longer to receive cash from cash sales, or even longer to make a credit sale. That then draws out the period of waiting for receiving accounts receivable. Now, if we're receiving cash flow from cash sales and accounts receivable, it means we're going to be slower to pay back accounts payable. Or alternatively, we're not going to be able to meet other obligations. So it's that real flow-on effect. So what can we do? What can we do to maintain, manage inventory, or use the inventory turnover to put strategies in place? What can we do? So firstly, we can maintain an appropriate inventory mix. So we're not having too many slow sellers out there. We've got the good quick sellers out there. We've got complementary goods. We are ensuring up-to-date inventory so nothing's expired. We rotate inventory, so if it's seasonal, that would make sense. We keep an appropriate level of inventory on hand so we have enough to make sales, but not enough. If we have too much, we'll bankrupt ourselves because we're holding too much inventory. We have good marketing, and we appoint an inventory manager, a person that goes, hang on, I need to reorder at an appropriate time. Now, I want to talk about complementary goods. I think that's a really good one to use in an exam. So if we go back, complementary goods, if we've got a golf club, wouldn't a complementary good be a golf club cover or a golf bag? You could market that all together and they're complementary goods. Likewise, if you're a bit more morbid, you go to a hospital, you have a get well soon card and flowers. That's where that could work. That's a way you could make that tie in. So let's look at an exam question. So I'm just going to bring up the exam now. Okay, looking at what we've got, you can see I've got an exam. This is from the 2019 accounting exam. It's question 7 on page 9. I'm just going to skim read through it. Health 900 sells health products to a growing market. The owner is considering selling the business and desired the high profits needed. However, the owner does not wish to change the business model except for changing from FIFO to identify costs. Cool. The business purchased much more inventory than needed during the previous year. Inventory bought early in the year was often more expensive than inventory bought later in the year. That's nice. And then you've got for the current full reporting period, the business deliberately stacked items bought at the lowest prices at the front of the shelf, so these items would be sold fast. By doing this, the business hoped to report a higher profit and greater asset value that would have been possible using FIFO inventory cost assignment method. Okay. You just got to talk about how the profit, increased profit, but I want to discuss the ethical issues the owner should consider and some qualitative characteristics of the inventory being stacked in this way. So I think I'm more interested in the ethical issues here. So health products normally will have an expiry date. I think that is so important to remember. Stuff like health products will have an expiry date. So what's the ethical issue of putting the stuff that will expire later first? Is you're going to potentially be selling expired stuff to other customers. I think that is kind of messed up. So I think that is 100% something to consider. I think also if you were to look at qualitative characteristics like the question asked, I think faithful representation is the most obvious, because you're not faithfully representing the business, because you're saying you've got this inventory on hand and you're stacking it this way and it's going to expire, so some of it probably has expired, and so that's a problem. I think that's where the issue is. And how do we know that? Well, quite simply, it says in the second paragraph, inventory was bought early in the year was often more expensive than inventory bought later in the year, and they're putting the cheaper inventory at the front. So that's where that comes in. I think that's a really interesting question, and that shows the importance of understanding how the real world works. So anyway, on that note, please like, please share, please subscribe. Thank you for watching. Share it with people. I think accounting is pretty good, and this is an interesting chapter. Good luck for your upcoming SACs when you do them, and I will see you next time. See ya.